FTX was once the crown jewel of the crypto revolution, a platform trusted by millions of traders worldwide. Founded by a young, charismatic leader, Sam Bankman-Fried. He was hailed as a visionary of decentralized finance. Celebrities, politicians, and institutions embraced FTX. At its peak, FTX was valued at over $30 billion. Investors were dazzled by its meteoric rise. But beneath the hype, something was amiss. Customers trusted FTX with their funds. They believed crypto could mature, and FTX was a safe harbor. But a house of cards can look solid from the outside. And when confidence cracks, it falls fast and without warning. FTX didn't just grow fast, it grew trusted. People believed it was different from the rest. Sam Bankman-Fried wasn't flashy, he looked different, not your typical billionaire. Messy hair, t-shirt, shorts, that's how he showed up, even in important meetings. He wasn't selling luxury, he was selling intelligence. That was his real currency. The media called him a genius. They saw him as a visionary in crypto. The next Warren Buffett of crypto. That's what people called him in the press. FTX secured massive sponsorship deals. Big names, big events, everyone wanted in. Arenas, celebrities, Super Bowl ads. FTX was everywhere you looked. Politicians welcomed him into Washington. Sam was invited to important meetings. He testified in Congress about crypto regulation. Lawmakers wanted his opinion. Investors saw legitimacy. They believed FTX was the real deal. Customers saw safety. They trusted FTX to keep their money secure. And almost nobody asked what was happening behind the scenes. Behind FTX, there was another company, Alameda Research. It wasn't just another startup. It was a crypto trading firm, and it was deeply connected to FTX. FTX handled customer deposits. Alameda made high-risk bets. Billions of dollars moved between them. Money customers thought was sitting safely was allegedly being used elsewhere. The structure was complicated, but the risk was simple. If prices dropped, everything could collapse at once. Then one report changed everything. A crypto news outlet published a balance sheet. It revealed something few people understood. Alameda's assets weren't what they seemed. A massive portion was tied to FTT. FTT, the token created by FTX itself. In other words, the empire was propping itself up with its own printed token. If FTT dropped in value, the entire structure would shake. And when the market saw that exposure, the panic started immediately. It started quietly. Investors began to question FTX's balance sheet. Then a rival stepped in. Binance announced it would sell its FTT holdings. The market reacted instantly. FTT's price began to fall. Customers rushed to withdraw funds. Billions were requested in hours. FTX didn't have the liquidity. Withdrawals slowed. Then they stopped. The exchange froze, and the crypto empire began collapsing in real time. Within days, the unthinkable happened. FTX filed for bankruptcy. A company once valued at $32 billion was suddenly insolvent. Customer withdrawals were locked. Billions in deposits were frozen overnight. The new CEO stepped in immediately. He called the situation unprecedented. He said he had never seen such a complete failure of corporate controls. Internal records were missing. Basic accounting systems didn't exist. Money had allegedly moved without clear documentation. Trust evaporated instantly. Crypto markets shook across the world. And Sam Bankman-Fried's empire was officially finished. Just weeks after the collapse, the focus shifted. It was no longer about the company. It was about the founder. Sam Bankman-Fried was arrested in the Bahamas. U.S. prosecutors moved quickly. The charges were severe. Fraud, conspiracy, allegations that customer funds had been misused. Regulators claimed billions were missing. Investors who once praised him now distanced themselves. Political allies grew silent. The crypto genius narrative evaporated overnight. Court filings painted a darker picture. Internal messages and testimony began surfacing. And the story was no longer about innovation. It was about accountability. FTX didn't collapse because crypto failed. It didn't fall because of market volatility. It collapsed because trust failed. And once trust breaks, everything accelerates. At its core, this wasn't a technology problem. It wasn't innovation that broke down. It was governance. It was oversight. Billions of dollars were built on confidence, on belief in leadership. And confidence is powerful, until it isn't. The messaging was disciplined and the growth looked unstoppable. But appearance and structure aren't the same thing. Behind the scenes, risk accumulated quietly. Small decisions stacked on top of each other. Pressure building beneath the surface. Money allegedly moved between entities. Lines blurred, oversight weakened, and complexity replaced transparency. Markets don't destroy companies. Weak structures do. The market just exposes what was already fragile. Hype can inflate valuations. It can lift numbers higher than fundamentals justify. But hype cannot replace structure. Markets don't destroy companies. Weak structures do. Pressure doesn't create the cracks. It reveals them. The same pattern has happened before. Different decade, different industry, same human behavior. There is always a story too good to question. A founder too confident. A crowd too willing to believe. FTX became a warning. Not about crypto, not about innovation, but about accountability and control. This won't be the last empire to fall. Another breakdown is already waiting. Because when power grows fast, the cracks grow faster. Boardroom Fallout.